Every single day, there are ebb and flows in the market. If you look at the big picture, there's always this flowing cycle of up and down. Most people just assume that it's random and they try to buy high and sell low. But I'm going to tell you right now, they are all Fibonacci retracement levels. Everything with price action is a Fibonacci retracement, whether it's on a 1 minute time frame or a 4 hour time frame. And I'm going to show you why in this video. Welcome back to the channel, everybody. My name is Artie, and this is The Moving Average, a show where we discuss everything day trading to keep you profitable on a consistent basis. So for those of you that have been here since day one, you know that I've already done a video on Fibonacci retracements, but because we have more people on here and the fact that people don't like to watch older videos, I'm gonna make a new upgraded Fibonacci retracement video, which is this one. So if you guys don't know what Fibonacci levels are, make sure you Google it because the entire universe is surrounded by Fibonacci retracements. They happen in nature naturally. They happen in the human psyche. They happen with the length of your arm to your nose and the proportion of the height of your body. And if you're a crypto trader, I've got a little bit of a bonus piece of information for you if you stick with me till the end. So without further ado, let's jump into the charts. I'm going to show you a quick few examples, and I'm going to help you get your Fibonacci retracement tool set up. All right, so this is my chart on Australian dollar, US dollar on a 5 minute time frame. I have 3 moving averages up. It is the 21, 50, and 200 smoothed moving averages, as well as an RSI, but it's a little bit different. If you don't know how to use the RSI like I do, watch this video right here. Basically, I just make one line at the 50. So like I was saying in the intro, there is ebb and flow in the market, constantly up and down. Now, this strategy is very, very useful, especially for a trader that likes to hold a position for a long period of time. This is not a scalping strategy. This is a intraday trading strategy, meaning that your position is usually closed by the end of trading day. So if you're a new trader and you see something like this, you understand that there's flow in the market. It goes up and it goes down depending on supply and demand, and market opens and market closes, consolidation periods, bull runs, bear runs. But there is actually a pattern to this if you can use the Fibonacci tool properly. Now, on the left-hand side of your screen, the third option down in the toolbar is the Fib retracement tool packet. You have Pitchfork, Shiv Pitch, all of this stuff right here, none of which I use, but if you do, you're smarter than me. Just go to the Fibonacci tool. It's in the middle. Put a star next to it, and that will populate it on your magically floating toolbar that has all of your favorite tools on it. If you're not using this, you should be. So once it's on your toolbar, you just click Fibonacci retracement tool and you just draw it anywhere that you want. Once you do, you'll get this little pop-up menu right here, and you're gonna click on the settings. What I want you to do is change your settings to what I have here. The colors, the numbers, everything. You're gonna have 10 Fibonacci levels. The 0, the 0.382, 0.5, 0.618, 0.764, 0.88, and so on and so forth. Exactly like this. Take a screenshot and make your Fibonacci tool look like this. Okay, with this Fibonacci retracement strategy, what I want you to do is not overthink it, not go for too long of a position. I just want you to catch the price action back to where it started. I'm gonna explain that in just a second. So basically this price action is from the 16th of March, and I can see so many Fibonacci retracements, it's ridiculous. But I'm going to focus on these 2 big ones. This is a Fibonacci retracement and this is a Fibonacci retracement. Okay, so the first one. Basically what you're looking for is one big fat movement from up to down or from down to up. This is a non-stop movement. Yes, there was a little bit of shakiness, but it literally in one direction, non-stop. These are the huge moves that you're looking for a retracement for. Here's what a retracement does. There is massive momentum in one direction, and then it gets tired and has to take a break as the price goes up and then continues in that direction, because originally there was so much momentum in that direction, causing these huge drops and rallies in the price. So once you've seen one of these huge bear runs right here, and then it starts consolidating and the price goes up, this is when you're like, okay, I'm looking for a Fibonacci level. So you take your tool from the top to the bottom. It does not have to be precise. It doesn't have to be on the bodies or the wicks or whatever. It just gives you a general sense of where the price is going to retrace at. We're going to drag that out a little bit, and you can see the price went down, stopped right here. So you already have your top and your bottom. And basically on Forex, only with Forex, you're looking for a 50 level retracement. You can see the price as it started consolidating shot back up. 50 level retracement, it's half, right? So it retraced half of where it went, consolidated for a bit, and then went straight down to where it was before, maintaining that bearish momentum. So what I want you to do on my other Fibonacci level, I have other take profit levels right here. Take profit 1, take profit 2, and take profit 3. But what we're gonna do is only stick with take profit 1. It is the easiest to get every single time. So the price went up to the 50 level. You place your short position right here, stop loss to the 764 and targeting take profit 1. That was 56 pips, and that move happened in 17 hours. Now this is a 5-minute chart. So you're gonna place your order here, you're gonna place your take profit at the low point that it was at, and you walk away. Now we saw another big momentum swing right here to the upside. So again, we take our Fibonacci tool, we take it from the bottom to the top, we spread it out a little bit so it covers the price action. We see the price went up, starts coming down, starts stalling out and consolidating, and then again goes back up to the price where it was before. Now this one's a little bit different, and I want to explain why you shouldn't get in too early on Fibonacci retracements, because it could actually be a retracement on a higher time frame. So you need to be aware of that and not get in as the price is going to the 50, but as it plays with the 50 and then goes past it. Listen to what I'm saying here. This right here is the 50 level. This is the 618, and this is the 762. The price went down and started coming up, playing again on the 618, and then passing through the 50. Basically, you should have your order here when the price is here, so that if it does go up this way, you are already in your position. So let's place our long position right here where it should be. You should have an order placed in advance. If it goes past that price and then comes down, that's when your order should execute, as it's passing through it. So again, you target the high point that it was at with a stop loss at the 764, only on a 50 level retracement. If you want more details, watch my other Fibonacci retracement video and you'll get more information on that. But if you're getting in at the 50, your stop loss is the 764. Again, target up at the high point that it was at, and that happened in 12 hours, you got 57 pips off of one swing. The reason I say this is not a scalping strategy is because scalping strategies are like quick entries and exits. These are long-term positions. One of them was like 17 hours. This one was 12 hours. So these are set it and forget it positions. If you got stopped out, you're going to make your profit on the next one, which is going to cover your loss, because these are about 1 to 2 risk to reward ratio trades. So for every time you win, you can afford to lose twice and still be break even. So as promised, if you are a crypto enthusiast and you day trade cryptocurrencies, Fibonacci tools are the #1 tool you should be using when it comes to crypto and buying the dip. The whole reason I know anything about day trading and technical analysis is because I have been in the crypto industry for a very long time. I helped another cryptocurrency exchange get their YouTube channel up very high, and I started trading on crypto. I didn't start trading on Forex, and the way that I learned to buy the dip was with the Fibonacci retracement tool. That's why I use it in my tool belt every single time when I'm trading on a long-term basis with my cryptocurrencies. So the reason it works so well, this is Bitcoin USD. We are on a bull run. We have been on a bull run for a long time, but a bull run can't last forever. And when it starts going down, it will retrace at a Fibonacci level and then continue up. So we're looking for the big bull swings. We have this one right here. We have another one right here. Constant movement in the up direction. So you take your Fibonacci retracement tool, you put it at the bottom, drag it to the top, and we got a 50 level retracement right here. Again, we take the next bull movement up from the bottom to the very top of that move, and we got a 618 level retracement right here. Now you have to be looking at a higher time frame when it comes to these pullbacks on cryptocurrency, so you get the big picture. You're trying to buy the dip. You're getting that huge rally, it starts dropping down, everybody's panicking and selling off, and it's going to go back up because it's crypto and it's crazy right now. So that's where you buy your dip. If you're looking to get more cryptocurrencies in your balance, you need to buy the dip at a lower price because you're going to get returns quicker than the average person just nonchalantly investing wherever. Now that was on the 1 hour chart. Let me show you what it looks like on a daily time frame. You can see we had this big, huge bull run right here. We have another one right here, and another one right here, and another one right here. Every single one of these is a Fibonacci retracement level. As you can see here, we had a 50 level retracement, a 50 level retracement, a 618 level retracement, and this one stopped out, but basically it's a retracement on a higher time frame. So out of all of these, you would have gotten stopped out once on every single buy the dip. So this is not a intraday trading strategy for Bitcoin or cryptocurrencies. This is a long-term position holding strategy to help you find out when to buy the dip. Buying the dip is the most lethal thing when it comes to getting value of your cryptocurrency investment in a short period of time compared to, again, just nonchalantly buying Bitcoin whenever. So I don't use Fibonacci that much on Forex because I'm a scalper with Forex, but I use it every single time I buy any amount of cryptocurrency. I'd love to know in the comment section, do you own any crypto? Do you have it long term, or are you a crypto day trader? Leave it in the comment section down below. And also, would you guys like to see live technical analysis, like a pre-London session live stream? I was thinking about doing it. It was a suggestion from a viewer. So if you guys would like to see that, let me know in the comment section down below. If you are still watching this video, that means that you like the video. So if you wouldn't mind, smash the big thumbs up button right below my face over there. If you guys want to see the most lethal 1-minute Forex scalping strategy video on the internet, watch this video right here. And if you've gotten some value out of this video and you like the channel and you like the way that I teach, make sure you're subscribed to the channel by clicking this big yellow TMA button right here. That way you'll never miss a new video that I post. Thank you so much for watching, and we will see you in the next video.